Welcome to the Deep Dive. Today we're cracking open the third quarter 2025 earnings results for Bristow Group. That's ticker VTOL.
Yeah, and this call, it happened intraday, November 5th. It really gave us one of the, let's say, more puzzling signals we've seen this whole quarter.
It really did. You had this huge financial beat on one side.
Massive outperformance.
But then the market reaction, it looked like investors just, headed for the door. The stock took quite a hit that day.
Despite management sounding pretty positive about the longer term.
Exactly. So that's our mission for this deep dive. Figure out that paradox. What did management actually say about the setup for 2026 that maybe the market just glossed over?
And why were investors so spooked by the immediate operational picture?
Right. If you're trying to get a handle on the VTL story quickly, this should help.
Okay, let's start with the numbers because they tell quite a story. Kind of complex.
They definitely made you look twice. So VTO reported GAAP diluted earnings per share of $1.72.
And the street, the consensus, was looking for something around $1 or 2 cents.
Yeah, so that's a beat of, 69%? Just completely smashed expectations. Normally that signals a fantastic quarter.
Normally, yes, but context is everything here. Because if you look at the top line, the revenue.
The story flips.
Completely. Total revenue, $386.3 million. The street wanted closer to $400 million. So they missed by, call it 3-4%.
Okay, so a big revenue miss, but a huge EPS beat. That usually screams, aggressive cost cutting or maybe some kind of non-operational boost.
Could be. Revenue did tick up sequentially, about 2.6% quarter over quarter.
Right. But missing the top line while blowing out the EPS number like that, it kind of signals to investors that maybe the underlying demand story isn't quite as strong as that EPS suggests.
And that's precisely the signal the market seemed to grab onto initially, that near-term weakness. Everyone focused on the core demand, especially in Offshore Energy Services or OES, which really drove that revenue miss.
But if you dig deeper into the operational metrics, maybe there's strength that got overlooked.
I think so. Let's unpack that because the balance sheet management looks pretty disciplined.
Yeah, let's talk about that.
Okay, so adjusted EBITDA, it climbed to $67.1 million. That's up 10.6% just from the previous quarter.
Wow. Okay. What drove that?
Margin improvement, definitely.
Yeah.
And cost control. Plus, look at cash generation. $20.3 million in free cash flow. And liquidity looks solid too. $313.4 million, with most of that $245.5 million in actual cash.
That FCF number plus the cash buffer, it does suggest they're being careful with capital.
And you saw it in their actions.
Yeah.
They paid down almost $25 million, $24.8 million, actually on their UK search and rescue, the SAR debt.
Okay.
And they gave up optimizing the fleet too. Sold 2 AW139 helicopters. One is a sale leaseback, so they're still using it, but it helps the balance sheet. They're actively managing things.
All right, actively tidying up. Now let's pivot to the segments because you mentioned the divergence there. That seems key to understanding Q3.
It really is. Government services was the clear winner this quarter. Revenue up 9.1% sequentially.
Okay, what was behind that?
Mostly the Irish Coast Guard contract, the IRCG, they're transitioning that. Added an operating base in Q3. Management basically said, look, the transition costs have been a drag on profits in 2025. But that drag flips to a massive upside in 2026. They're expecting adjusted operating income from government services to almost double year over year.
Double. Okay, that's a powerful narrative. But if government is the engine, then Offshore Energy Services, OES, that sounds like the anchor slowing things down for now.
That's a fair way to put it. OES revenue dipped slightly, 0.9% sequentially.
And that's where the market fixated, right?
Exactly. Utilization was down noticeably in Europe and Africa. That confirms some softness there. It did tick up a bit in the Americas, so it's a mixed picture regionally. But overall, that top-line weakness in OES just overshadowed the good news from the government side.
And we should probably circle back to that non-operational boost you hinted at earlier. The vendor credits. How much did they really help that big EPS number?
Yeah, we need to be clear on that. The CFO mentioned it directly. Bristow got a material benefit from higher vendor credits in Q3.
Okay. And what are those typically linked to?
Things like buying assets, signing long-term maintenance deals, or even compensation when, say, an aircraft manufacturer, an OEM, has delays or performance issues.
Right.
Now, these credits are normal in the industry, part of the whole capital cycle, but the scale of them this quarter definitely gave the reported results a tailwind. It likely inflated that GAAP EPS number beyond just core operations.
Got it. So Q3, Strong EBITDA, good cash flow, disciplined balance sheet management, but a revenue miss because OES was soft, offset somewhat by government strength and those vendor credits.
That's a pretty good summary, yeah.
Okay, so let's look ahead now because this is where the market reaction gets, well, really puzzling. Management admits OES is weak right now. So why did they raise their guidance? Massively.
Yeah, it's a head scratcher at first glance. They do acknowledge the current environment. The CEO, Chris Bradshaw, he talked about the long-term outlook for offshore deepwater projects being positive, attracting capital. But he said the industry is kind of in a mid-cycle activity plateau right now in the near term.
A mid-cycle activity plateau. That sounds a bit like corporate speak for maybe a longer slowdown, doesn't it?
Yeah.
Especially after they just reported lower utilization in Europe and Africa.
It could sound that way.
And they're still wrestling with these supply chain problems, right? They said it caused lost revenue, even penalties in OES. So how can they be so bullish on 2026 pricing at the same time?
Okay, this is the absolute core point the market seemed to just skate over. Management's confidence isn't really coming from some sudden explosion in demand.
No. Where's it coming from then?
The supply.
Bigger.
Critical supply constraints. They kept hammering this point. The existing fleet of heavy and super medium offshore helicopters. Globally, it's basically in full effective utilization. There just aren't many spare aircraft sitting around.
Okay. So they can't just ramp up supply quickly, which gives them pricing power.
Precisely. The production lines for new heavy helicopters are super tight. They often share lines with military orders, which usually take priority.
Right.
So lead times for new birds are running like 24 months or even more. Management's argument is this tight supply gives us leverage on pricing and utilization heading into 2026, almost regardless of this current plateau.
Okay, that context helps explain the guidance then. Let's just pause on that. They didn't just stick with the old 2026 target. They raised it and tightened the range.
Yep. New 2026 adjusted EBITDA target.
Yeah.
$295 million to $325 million.
Wow. Compared to 2025, what kind of increase is that?
The midpoint of that new range is roughly a 27% jump over the 2025 midpoint estimate.
27%. Okay, that is a massive projection. They're basically forecasting really strong, almost non-cyclical growth.
And it's largely built on those government contracts hitting their full high-margin stride, plus that OES pricing leverage story.
Okay, let's drill into OES a bit more. Are there any specific regions looking strong enough to support that pricing optimism?
They sounded quite positive about Brazil, Africa, and the Caribbean. Those areas are actually seeing net aircraft inflows to meet demand.
Okay, so growth there. What about the U.S. Gulf?
Stable, but maybe less of the quick, ad hoc work they sometimes see.
And the North Sea. That's often seen as a tough, mature market.
Yeah, activity there is softer. Management was clear. The new AW-189 helicopters they're putting there, those are mainly strategic replacements for older S-92s.
So not chasing volume growth, more about locking in profitable long-term deals.
Exactly. It's about value accretion, getting better returns, not betting on a huge regional boom.
So the bull case really hinges on two big things. Government services profits nearly doubling in 26, and OES using that tight supply to push pricing higher, even if overall activity is just okay.
That's the core thesis.
But those supply chain issues, they haven't gone away, have they? That feels like a real headwind.
Oh, absolutely not. They're persistent. Management talked about ongoing delays getting parts components, especially in the aftermarket. And it's not just old planes. It's hitting key newer models too, like the AW-189.
And this is critical. It's not just causing maintenance headaches. They specifically said these supply issues cost some revenue and led to contractual penalties in OES this past quarter.
Yes, that's a concrete, real impact that the market is definitely pricing in right now.
Which means those 2026 catalysts you mentioned, they really need to hit perfectly to make that 27% EBITDA growth happen.
No question. Execution is key.
So what's the roadmap look like? What has to go right?
Okay, number one, get that Irish Coast Guard contract fully operational, running smoothly at its expected rate, and execute the transition to the new UK SAR-2G contract without major hiccups.
Right, the government side.
Number two, successfully use that tight helicopter supply during the 2026 OES contract renewal season to actually get those higher prices locked in.
Prove the pricing leverage theory.
Exactly. And number three, keep optimizing the fleet, selling off non-core assets, maybe doing more sale-leasebacks, just keeping that balance sheet strong.
Okay, let's shift gears slightly. What about the longer-term strategic stuff? Advanced air mobility, AAM, eVTOLs. Bristow seems perfectly placed for that, given all their infrastructure.
They do, and they're approaching it pragmatically, I think, like a smart first mover. They expanded their partnership with Vertical Aerospace, and they talked up this Norway sandbox project they're running, which sounds kind of cool, actually.
What is that exactly?
They're flying a real all-electric aircraft, the Beta CX-300, in real, potentially harsh Norwegian conditions. They're using their existing bases, their know-how, just collecting data on how these things actually perform, what it takes to operate them.
That's clever, using today's expertise to get a leg up on tomorrow's market. But they were pretty realistic about when this might actually make money, right?
Very realistic. They said, look, maybe some AAM models get certified starting in 2026, but our guidance, it includes zero contribution from AAM.
Zero.
They think first deliveries, actual commercial revenue.
Yeah.
That's probably more like 2027, maybe 2028. So it really is a long-dated option right now, not impacting the next couple of years' numbers.
Got it. Okay, let's circle back one last time to the 2026 financials, just to nail down the conviction level. What about free cash flow? Does that projection back up the big EBITDA jump?
Yeah, the cash flow story holds up. They expect to spend a fair bit on CapEx in 2026, around $100 million.
Okay.
And most of that, maybe $80 million, is specifically for growth, buying those new AEW 189s we talked about.
Right.
But even with that significant spending, they're still projecting free cash flow of about $140 million at the midpoint.
$140 million FCF, even after growth CapEx.
Yeah. And if you look at their current market cap, that implies a pretty substantial FCF yield. It does add weight to their confidence about profit expansion next year.
Okay. This brings us nicely to the part where we try to connect the dots between the numbers, the story, and maybe, how someone might think about this from an investment perspective. And just a reminder to everyone listening, this is absolutely not financial advice.
Definitely not. But thinking about the psychology.
Yeah.
The market sold off, right? It priced in that Q3 revenue miss. It priced in the anxiety about the OES plateau, the supply chain headaches.
So it basically created an entry point for people who believe the 2026 story.
Potentially, yeah. So let's call it outrageous but plausible trade idea here is really a conviction bet. You're betting against the Q3 noise.
And on that 2026 inflection point, on that 27% adjusted EBITDA growth, backed up by the strong FCF guidance.
Exactly. The idea would be to go long, looking at it as maybe a multi-quarter play. You're focusing on the government services margin expansion kicking in.
Right.
And critically, you're betting that Bristow, as the world's biggest operator of the key heavy helicopters, the S-92s, EW-189s, AW-139s, really can dictate pricing in 2026 because supply is just that tight.
Betting that their leverage in negotiations is maybe stronger than the market currently believes.
Yeah, that they can push pricing beyond what's currently baked into expectations.
And then there's the strategic kicker, the AAM angle.
Right. You sort of view those Vtol partnerships with Beta and Vertical as like a free, long-dated call option.
Explain that.
Well, the market isn't really paying anything for the potential of decarbonized aviation today in Bristow's stock price. But Bristow is actually doing the groundwork, positioning themselves. So if or when that market develops, they're already there. It's potential upside that doesn't seem priced in.
Okay, so a value proposition possibly hidden by all the near-term operational static.
That's the argument, yeah.
All right, so let's wrap up this deep dive. Q3, you had strong margin control, government services ramp-up looked good.
But the OES revenue miss and the supply chain issues really grabbed the headlines and spooked the market.
Right. But the key message, the one the market seems to be discounting right now, is management's really high conviction in hitting that 27% adjusted EBITDA growth in 2026.
A conviction backed up by those strong free cash flow projections.
Okay, so that leaves you, the listener, with this final thought to chew on. Management kept stressing how tight helicopter supply is and how that supports their 2026 pricing power.
So the question is the current consensus maybe underestimating the leverage Bristow actually holds in those upcoming contract talks with the big energy producers? Could that mean their raised 2026 EBITDA guidance is actually conservative?
Something to think about. Thanks for joining us for this deep dive.
We'll catch you on the next call.